Hello, everyone, and welcome back to Foundations of Business, Management 1104. I hope everyone is doing well. Let me share my screen here. We're going to talk today about finance and accounting and kind of walk through what it is and it is about, and kind of going through getting you prepared for your quiz, which is later this week, on the accounting transactions that lead to financial statements. And so today it's kind of like, why do we do that? Why does an organization need finance and accounting? Some of it's fairly intuitive. I get that. But we also want to look at the transactional activity, careers, and the such within finance and accounting. So we're going to, again, explain the differences between accounting and finance, kind of looking at the users of accounting information, and start to give you an opportunity to explore what these transactions look like. I'm not going to share specifically the video. Please do that though in Canvas. So there is an Department of Accounting video. There is a Department of Finance video. Please take a look at these. These are two very, very successful and strong departments within the Pamplin College of Business. We have extraordinary alumni, long history and legacy of success, career success by our alumni in both accounting and finance. So please take the time to watch that and understand what that looks like. So what is accounting? Accounting really is the language of business. We start to understand the financial information from an interpretation, being able to communicate the results to management and other decision makers, and really, again, measuring and summarizing the financial activities within a company, within an organization. That's the proper accounting definition. Two different types of accountants. Managerial, this is information for decision makers within the company, managers, directors, supervisors. The reports can be structured for a wide variety of purposes and really tailored. Those reports can be tailored for the specific needs of individual managers. So that data can be produced in whatever way is needed for that particular manager, obviously within limits of the software and the output. But the whole point of it is, in order for a manager or director to be able to make the best fiduciary decisions, could be about people, could be about budget, could be about a customer. There's a number of reasons why that data is important to them, but they have to have the data in order to understand it. So for me, for example, I led our sales and marketing team in a specific industry area, and I wanted to know from an expense report standpoint, how much was a particular marketing or sales colleague spending on a different customer, on a specific customer? What about trade shows? How much are we spending there? And so, just one data point of what we're talking about. Now, financial accountants, again, assessing the financial performance of the company, but being able to provide that data both inside and outside the firm. And the financial accountants are also responsible for the company's financial statements. So an example here, financial accounting prepares the summary level results. Managerial accounting might break down those results by region, product line, or number of other variables. So financial accounting is sort of that executive summary, whereas managerial accounting is down to the very specific line level of that. Now, accountants versus financial managers. Accountants keep the books, prepare financial statements, prepare the taxes, look at internal controls. Financial managers develop strategies to improve those results. So they're looking at the executive summaries, they're looking at data, operational cost, all these things, and they're developing strategies to improve those results. In addition, they're raising funds to finance operations too. Two different types of financing. Debt is borrowing money to fund the operations. The lender typically gets no ownership in the firm, okay? So think about a credit card, your own debt. The lender does not get ownership in what you buy or anything like that. Equity is raising money to sell a portion of ownership for the company. This is what we see on Shark Tank, right? Give you $8 million, I want 20% of the company. Types of debt financing. So there's secured debt, and that's borrowing money but giving collateral. So presenting collateral as part of that. Lender can take the collateral back if not repaid. Unsecured debt is there's no collateral offered. The loan is usually made based on the borrower's payment history. Okay. Some examples of debt financing. So secured would be a mortgage loan or a car loan. Okay. So if someone doesn't make a mortgage loan payment, what happens? The bank will come and foreclose on that home and take that home back. Someone doesn't make a car loan, 2-3 months pass, there will be a tow truck that will come and take the car away. Okay. Now, unsecured, you may already be participating in unsecured debt financing, just like a company could be credit cards or, like, for example, a student loan. Let's look at financial accounting, the different types of financial statements. One is an income statement, another is a balance sheet. We're going to focus on that the next few days. You're going to be learning more about income statements and balance sheets, statement of owner's equity, and then statement of cash flows. Some key terms, you can see them there. The one that you'll see quite frequently is GAAP, which is the generally accepted accounting principles. Those that are going to go in more into accounting and finance, you will certainly learn a lot more about all three of those different principles, boards, and standards. Let's look specifically at the income statement and what an income statement represents, okay? Keep in mind, revenues equal sales, okay? So when we're talking about how much did we sell, that refers to revenue. Cost of goods is variable cost, i.e. material and labor. How much or how many people did it take to have to make that product? What did the material, how much did the material cost to make that product? Something as simple as, let's say we had a bakery, okay? And it took 2 or 3 people, let's say 3 people, a baker, you had someone in customer service, you got someone in packaging, all right? So 3 people to do that. What did the material look like? We had to have milk, eggs, yeast, dough, chocolate chips, you name it, right? Whatever that recipe is, that becomes the material within that, okay? Gross profit or margin is basically sales minus cost of goods sold. That's our gross profit. Operating expenses, these are fixed costs. So keep in mind, fixed cost would be our advertising cost. How much does it cost every month to have a billboard? How much does it cost to have a website? That's advertising cost. Overhead, other fixed costs would be how much does it cost to have a storefront? So think about downtown Blacksburg and any one of those storefronts. Sharky's, for example, right there on the corner. They have the same rent every month. That's a fixed cost. It's not based on how many people come in and out of the restaurant. As far as how much rent they pay a specific number every month. So your net income or net profit then is the gross margin. Remember, we defined a gross margin as sales minus cost of goods. And then it's gross margin minus the operating expenses gives us our net income or profit. All right. Now let's take it from a personal standpoint. All right. Think about your own life. So your assets would be cash and savings. Maybe it's a car or a condo. Your liabilities might be a car loan, mortgage, or a student loan. Now, the difference between the total, okay, the difference between assets and liabilities is the owner's equity. Okay, so this gives you a chance to look at a balance sheet. All right. So assets equals liabilities minus owner's equity. Excuse me, assets equals liabilities plus owner's equity. So the difference between these totals becomes the owner's equity. So the fundamental accounting equation, I just said it, even though I got it wrong, but at the end of the day, corrected myself. Assets equals liabilities plus owner's equity. Let's look at what that looks like, okay? Assets are the value of what you own. Liabilities is the value of what you owe. So you got own and owe, okay? And then owner's equity is the accounting-based value of the business, all right? So again, assets minus liabilities would then equal owner's equity. Now, one of the important parts of owner's equity, this does not equate to the market value of the business, all right? So that's stock prices. We've been watching stock prices this session. So keep in mind, the owner's equity is truly that. How much equity is in the company has nothing to do with what the market says through stock prices, what the value of the organization. All right. Now, some other balance sheet pieces. The debt side is cash, receivables, and properties. Okay. Cash, receivables, and property. And you'll see this in practice when you watch the video, the crosswalk video of financial statements. Liabilities are payables, loans taken, and debt issued. All right. And then owner's equity, those are on the credit side. Debts and credits must balance for every transaction recorded. You'll hear me say double entry accounting. Okay. Very, very important. And so accounts have to, look at expenses and revenues on both of that. And so the balance sheet, let's look at the beginning period. So as of September 1st, we had assets, cash of 600, liabilities of 400, owner's equity of 200. Remember, assets equals liabilities plus owner's equity. In this example, we see cash at 600. What does liabilities and owner's equity equal? 600, right? Then there's transactions throughout the month. There's all kinds of things going on the income statement side. We'll look at that in a moment to give us then our balance sheet. And so now assets are 700. So liabilities and owner's equity must equal 700, okay? So cash went up $100 because there was $100 earned during this particular period. Liabilities didn't change, still at 400. But owner's equity, $200 invested by the owner, plus $100 profits retained, gave us the 300. 700 equals 700. Always has to balance. Very, very important. Okay. So the balance sheet sequence looks like this. Cash, receivables, and properties, and then payables and long-term debt. A key point here, a key term, liquidity. How fast how fast can assets be converted to cash? Liquidity is how fast assets can be converted to cash. Very, very important to understand that particular term. Okay. Ratio analyses, these are in the textbook. Just some key points here when you look at liquidity. We just talked about it. How quickly can a company pay its bills in the near term? Debt ratio, how much borrowing has a company done? Very, very important. You can start to see what these formulas, what this mathematical equation looks like. So profitability is return on sales. Net income divided by net sales, right? Profitability, earnings per share. So if you're a shareholder, if you own stock, right? Very, very important to understand what your earnings per share. So it's net income divided by number of shares. Liquidity. So again, how quickly assets can be turned into cash. It's current assets divided by current liabilities. Debt ratio then would be debt divided by equity. Very important. Understand these. You'll obviously have access to this, when you're taking the exam. All right, break-even analysis. Very important to understand what level of sales do we need in order to avoid losing money? That's break even. The quick example I always like to get is, let's say we were going to sell ice cream cones on the drill field. We spend $50 on the cones. We spend $50 on the ice cream. If we're going to sell it, so we have $100, right? We have $100 in our material cost. In order to break even, if we sell every ice cream cone for $1, how many ice cream cones do we have to sell to break even? And it would be 101, right? We have to, the break even number is 100. At 101, we make a profit. So break even is 100 ice cream cones, because that's how much we have invested in that. It's important to understand. So we start to look at the break even analysis. Break even is the break even quantity, fixed costs, the price, the variable cost, and the contribution margin. And so here's an example. Your company sells inspirational message t-shirts. Consumers buy them from you for $10 each. Your cost per t-shirt is $3. Now, the fixed costs are $700,000 per year. Remember, fixed costs could be advertising, rent, all of that. So what's the break-even quantity? Well, let's look at it. So on each shirt, we receive $10, right? Consumers pay. Each one costs us $3 to make. So our contribution margin is $7. So if our fixed costs are 700,000, how many shirts do we have to sell? And the answer is 100,000, right? So we take the 700,000, we divide it by our contribution margin. So our fixed cost divided by our contribution margin, we have to sell 100,000 shirts to break even. Now, let's add markup. So we talked about markup in the pricing chapter, right? And so same thing, consumers buy them for $10. Walmart makes a 25% markup on the invoice price. Again, still $3. Our fixed costs are 700,000. What's our break-even quantity? Well, let's look at it. You got break-even, again, is fixed cost divided by contribution margin. Our fixed costs are 700,000. Cost of goods sold is $3 per shirt, but we got to determine what the price to our customer is. And so P equals 25% or $10. So we take $10 and divide it by 1.25, all right? Because Walmart's making 25% on every shirt, okay? They're marking it up 25%. Again, they're selling it to consumers for 10. So basically, they're paying us $8 per shirt, okay? $8 per shirt. So now we look at the break even. Remember, if you get a fraction, round down because you can't sell a partial t-shirt, okay? So 700 divided by 8 minus 3. So again, $8 minus 3, our contribution margin is $5. So a little bit different when you have the step distribution here. So now we have to sell 140,000 t-shirts in order to break even. All right, accounts for the exercises. So remember, you're going to be doing an exercise later this week. You'll see a crosswalk. There's a video out there to kind of show you, but remember, cash, any amounts on hand or in the bank. Accounts receivable. Accounts receivable are the amounts you have billed to your customers. They have not yet paid you, okay? Accounts receivable. Keep in mind, there's payment terms, usually 15 days, 30, 45, 90, whatever that is. So we make a sell, we do something, okay? We make a sell, but our customers don't pay us immediately. They're gonna pay us in 30 days. They're gonna pay us next month, okay? So we can't add it as cash yet. It's accounts receivable. We record it as revenue and we record it as an accounts receivable, right? Accounts for exercises, right? Keep going with that with property. This is the amounts that of things that we have bought, whether it's a plant, a vehicle, equipment, machinery, things like that. They have a long life, okay? 5, 10, 40-year life, okay? Very important for purposes of our exercises, we're going to be maybe up to 10 years. Low cost items like office supplies are expensed. Very, very important. Low cost items like office supplies are expensed. They're not part of your property. You go out and buy toilet paper, that's not property, that's an expense. The other thing is rules will vary, whether it's state, local, even federal, on how long life can be, whether it's a copier or a vehicle. And so rules will vary by company as well. So not only laws, but even by companies. So just something to keep in mind. Payables, so a little bit different. So accounts receivables we talked about, that's monies owed to us, monies owed to an organization. Payables are monies that are owed by the company and not yet paid for. So it's kind of like revolving credit, all right? So we might buy something, but we don't have to pay for it for 30 days or 60 days. That would be a payable. Bank loans kind of makes sense. Any amounts your company has borrowed and has not yet paid back. Owner's equity, we've talked about. It's the accounting value of the company, and it's the difference between assets and liabilities. All right. So be sure that you have read the chapter. There's a lot in this chapter, and so it's very, very important that you have read it. The other part is watch the video on the crosswalk of the transactions. Very, very important to see from an income statement and balance sheet of what that looks like. As always, if you have questions, feel free to reach out to me. Otherwise, take care, and we'll see you soon.